Well, hi once again, everybody. My name is Lori Page, and I'm coming to you from the advisory team here at Sound Wealth Management. Markets rarely give us clear skies, and there are always obstacles to watch for on the horizon. But the right preparation, context, and support can help us navigate anything that may lie ahead. So far, this year hasn't seen a full blown crisis like 2008 to 2009 or even 2020. But the ride has been very bumpy. We may not be flying into a storm, but there's been plenty of turbulence for the first part of 2022. How businesses, households, and central banks steer through the rough air will set the tone for markets over the second half of 2022. The sources of turbulence are clear. A global economy that was already vulnerable to inflation from supply chain disruptions, tight labor markets, excess stimulus, and loose monetary policy came under more pressure when Russian aggression in Ukraine added sharply rising commodity prices and Europe on the brink of recession to the mix. The effects have included renewed pressure on interest rates, which hurt bond investors and contributed to tightening financial conditions, and a much more aggressive stance by the Federal Reserve and other global central banks. Add in the typical market challenges of a midterm election year and the third year of a bull market, and it's not surprising it's been a bumpy ride. Understandably, rising prices, slowing economic growth, and a challenging first half for both stocks and bonds have many investors on edge, and fatigue from more than 2 years of COVID-19 measures doesn't make it any easier. But markets are always forward-looking, so it's important to remain focused on what lies ahead. There will most certainly be challenges, but there are also some tailwinds from a strong job market, still resilient businesses, and the likelihood that inflation will soon start to slow. Markets historically can even get a little lift from lower uncertainty around elections as the midterms approach. So, what do we expect from the economy? We believe that the domestic economy will continue to grow this year, albeit slower than we expected 6 months ago. Other than the anomaly of a negative print in first quarter gross domestic product, we think that the economy has sufficient momentum to offset inflationary pressures. Our base case forecast includes an inflation rate that moderates as supply bottlenecks improve, and we potentially get some closure to the Russian war with Ukraine. Our most likely scenario is the economy avoids an official recession as growth is expected to notch just above 2% in 2022, with another downshift to under 2% in 2023. These are annual figures, so intra-year economic activity could be quite volatile as the Fed becomes more aggressive in the tightening cycle. How about inflation? Inflation will most likely be significantly above the Fed's long-term target of 2%. Inflation rates will likely cool throughout this year, but the cool down period will be long and slow. Some inflation pressures should subside as China adjusts its COVID-19 policy and supply chains improve. A slowing housing market could also eventually ease inflationary pressures later this year and into 2023. So where does this leave your investments? Let's break this up into 2 categories. First, stocks. Stocks will face a number of headwinds in the second half of the year, but the amount of turbulence will likely depend on the pace at which inflation falls. Volatility may persist, but improved macroeconomic environment may set the stage for higher valuations, further earnings growth, and solid gains for stocks over the rest of the year. The challenge comes from predicting how fast inflation will come down. Our year-end fair value target for the S&P 500 is between 4,300 and 4,400 based on a price to earnings ratio of 18 to 19 and our 2023 S&P 500 earnings per share forecast of $235. Now for bond investors. The value proposition for core bonds is that they tend to provide liquidity, diversification, and positive total returns to portfolios. Unfortunately, none of those values is 100% certain all the time. Like all markets, fixed income investing involves risks and at times negative returns. However, despite the historically poor start to the year, the value proposition for core bonds has actually improved recently. With the big jump in yields that has already taken place this year, we believe that core bonds look as good as they have in quite some time. As rate hikes work their way through the economy and slower growth starts to get priced in, we could see the 10-year Treasury yield end the year between 2.75 and 3.25%. Policy will be another key ingredient in the mix. One of the things that we knew coming into the year was that 2022 would be a midterm election year, and those have historically not been kind to stocks. In fact, since 1950, midterm years have seen the largest peak to trough pullback of the 4 years of the presidential cycle, with the S&P 500 index down 17.1% on average during the year. The good news is, 1 year after those lows, stocks have been up more than 32% on average, and the S&P 500 has been higher a year after every midterm election since 1950, 18 out of 18 times, with an average gain 1 year later of a very solid 14.5%. It looks like a divided government is in the cards, which markets have also historically liked. So what are your alternatives? Losses across both stocks and bond markets in 2022 have left many searching for ways to further diversify their exposures. While alternatives cover a wide range of approaches, several have helped to fill the gap, and many continue to do so over the rest of the year. We continue to believe that our preferred alternative implementations, event-driven strategies, market-neutral strategies, and relatively conservative low volatility strategies have the ability to act as a source of ballast during such periods of high volatility. How about currency? As we enter the second half of 2022, the factors that led to a sharp, nearly uninterrupted ascent for the US dollar, such as a hawkish Fed and demand for safe havens, may begin to reverse. In the intermediate term, easing inflation from unsnarling of supply chains post-COVID, aided by China's reopening, should help push the dollar lower. And finally, commodities. Commodities have garnered support from both demand and supply, and we believe upward pressure on prices will likely persist for at least the next several months. Demand has gotten a lift as the global economy emerged from the pandemic. Sanctions on Russian energy exports have kept oil and gas prices elevated. Ukraine is an important global supplier of agricultural commodities such as corn and wheat, putting upward pressure on food prices. From an investment perspective, we would favor energy. The big thing to keep in mind for 2022 is that turbulence cannot be avoided, but it also need not deter us from making progress from our financial goals. This mid-year market update is designed to help you assess conditions over the second half of the year, alert you to the challenge that may still lie ahead, and help you to find the smoothest path for making continued progress toward your destination. When times are turbulent, the surest path toward progress remains sound financial advice from dedicated professionals who have logged many hours in similar conditions. We invite you to reach out to the advisory team here at Sound Wealth Management at 941-932-4822 or schedule your no-obligation consultation online at www.soundwealth.net, where Sound Wealth Management is more than just our name. Have a great day, everybody.